what's the big deal? Do you hear me? It's Kevin Cooley. From car crashes to Kanye West to violent rampages to serious scandals. I'm going to keep you guys connected. So do me a favor and buckle up and hit that like and subscribe button so I can take you along for this ride. Today we're going to the Silicon Valley, about the Silicon Valley Bank collapse and what you need to know about it. Questions you may have. What is SVB and how big is it? Silicon Valley Bank was founded in 1983 in Santa Clarita, California, and quickly became the bank of the burgeoning tech sector there and the people who financed it, as was intention. The bank itself claimed to bank for nearly half of all the United States venture-backed startups of 2021. It's also a banking partner for a lot of the venture capital firms that fund these startups. SVB calls itself the financial partner of the innovative economy. All that basically means is tight woven into the financial infrastructure of the tech industry, especially startups. Second question you may have, what happened to the SVB? Silicon Valley Bank met its demise largely as the result of a good old-fashioned bank run after signs of trouble began to emerge early this week. The bank takes deposits from clients, invest them in generally safe securities like bonds. As the Federal Reserve has increased interest rates, those bonds have become worth less. That wouldn't normally be the issue. SVB would just wait for those bonds to mature. But because there been a slowdown in venture capital and tech more broadly, the deposits inflow slowed, and clients started withdrawing their money. Questions 3. How did this happen so fast? Well, it's simple. Part of SVB's specific problem is that it was so concentrated in its business. SVB catered to venture capital and private equity, as the sectors have done well other than the past decade. So has SVB. But because the bank was already very concentrated with high exposure to one industry, that it opened to risk when things got bad for the non-diversified group of clients. It very quickly got bad for the banks. News. The failure of Silicon Valley Bank was caused by a run on the bank. The company was not, at least until clients started rushing for the exits, insolvent or even close to insolvent. But banking is an enterprise that relies on much as confidence as cash. And if that runs out, the game is over. The collapse may have been an unforced, self-inflicted error. The bank management chose to sell 21 billion of their bonds at a $1.8 billion loss. In large part, it appears because many of those bonds were yielding an average of only 1.79% at the time, when interest rates have risen drastically and the bank was starting to look like an underperformer relative to its peers. Moody was considering downgrading its rating. The bank management, with the help of Goldman Sachs, its advisor, chose to raise new equity for the venture capital firm General Atlantic and also to sell convertible bonds to the public. It isn't clear if the bond sale or the fund raising, at least initially, had been made under duress. It was meant to reassure investors, but it had the opposite effect. It is so surprised that market that it led the bank's very smart client base to venture capitalists to direct their portfolio client to withdraw their deposits en masse. General Atlantic equity investment could have been completed overnight, but the bank management also chose to sell convertible preferred stock, which couldn't be sold until the next day. That left time for investors and, more important, clients to start scratching their heads and sow doubt about the firm, leading to an exodus. The deposits There will be details postpartum of the bank's failure in the coming weeks and months. For now, it looks like the collapse could have been avoided. It happened because the management bungled how it communicated to the customers and the public and created a vacuum of confidence. But underlying the failure was a demonstrable problem, one to keep an eye on for other banks. The company had invested its deposits in a low interest rate bond that held its own, its books on long-term hold to maturity basis. This means that it did not have the mark to market these bonds until they were sold, leaving investors with a somewhat distorted view of balance sheet. So long as the bank doesn't need to sell hold to maturity assets to meet withdrawal requests, there's no problem. But if a bank has to sell at a loss, that's when things get complicated. We're also likely to hear more from Washington about bank regulation. It appears that the bank management successfully lobbied regulations in 2015 to loosen rules that might have prevented it from taking some of this risk it did. The Lever News organization reported about testimony that the company's president made to the Senate at the time, seeking to weaken some rules. So far, Silicon Valley Bank seemed an outer, given its unique circumstances and unusual client base. It had very few typical retail customers, as J.P. Morgan. Michael Kumblash wrote in a note to investors on Friday, but there's already nervousness about some small and regional banks. In an intermediate term, the most pressing problem this presents is for Silicon Valley itself. Venture capital firms that use the bank may struggle to gain access to their money and possibly that of their limited partners, including pension funds that had forward money intended for investments. This, in turn, may make it hard to fund current and new investments or to reinsure other companies inside and outside their portfolios. Dealbook is already hearing about secondary sales of private shares to fund both businesses and individuals. Conclusion: your money's not always safe in the banks. SVB only insures up to $205,000. What happens if you have a couple of $1 million in there? You just have to take that on the chin, pull yourself up by your bootstraps, and take the loss. To the people that don't have that much money in their accounts, you might get your money back, hopefully. But somebody's going to feel the burn. Until then, get your life right and follow Christ and quit the dissing. It's your man and not your boy, Kevin Cooley. Tell me what you think about it. Don't forget to like and subscribe.